More on the tech sector and the markets. We're joined now by Gabriela Santos, global market strategist at JP Morgan Asset Management. Gabriela, great to have you with us. From what I read, you thought that yesterday's decline in yields was largely technically driven, short covering there in the bond market. I'm wondering what you attribute today's move to.
Sure. Good to see you, Melissa. And I think we really have to be very careful here this morning about the narrative we tell about some weakness early this morning in markets. So I think we have some very unique dynamics happening for certain assets. And then even where there is a broader macro story, it's not really about variants or lockdowns. It's much more about what a normalized economy and earnings look like and whether we're paying the right price for that. I think in terms of Treasury yields especially, I would put it in the first bucket. This is very much a distorted market. We're in a particular time period here where the Fed is buying 100% of net Treasury issuance. That's something we had not even seen during QE over the last decade. And it's the kind of environment that investors were caught by surprise from the initial fall in yields are now scrambling to short cover. So it's very much a technically driven fall in yields, this retracement of about half of the move higher that we had seen in the first quarter. And for us, that's important because it means that once fundamentals actually reassert themselves in the Treasury market in the second half of the year, this will prove to just be a temporary retracement and we'll continue seeing a steeper curve in the second half of the year.
Why will fundamentals reassert themselves in the second half of the year when the Fed will still be a large purchaser of bonds?
So I think when we look ahead, second half of the year into next year and beyond, this strange dynamic where the Fed is buying 100% of net issuance is really going to fade and we'll go back to normal. So the first thing is the Treasury. Their issuance has been incredibly low, abnormally low, because they had already issued a lot of bonds in advance. So they'll go back to their regular issuance. At the same time, we do expect the Fed to announce that they will taper at some point in the future over the next 6 months. So their own demand of bonds will start to come down and investors will start to price that in. So then the market will become much more normal, much more focused on the normalized economic and inflation perspective in the future. We should see the 10-year, in our view, still end the year closer to 2% and continue its trajectory higher over the next 18 months towards its normal resting place, which is actually much closer to 3%.
So in a normalized market, Gabriela, what should valuations be? What should we be paying for the S&P 500?
So I think that is a big question because I don't think that this is really about the Delta variant. I think, it's proven to really have vaccines have really proven to have severed the link between rising cases and hospitalizations and fatalities. So we don't see a change in the reopening behavior. And it's not something at the moment that we expect to actually change fundamentals. So I do think investors are looking beyond the pandemic and thinking, all right, once we're past the recovery and we're really firmly in expansion mode, what is a sustainable growth rate for the economy, for earnings, what's up ahead? And I do think it's still very much a supportive backdrop. We don't expect a hard landing in the economy or earnings. It's more of a soft landing back to normal. But the trick is we have already priced a lot of hope into multiples. So really returns going forward are going to be a lot more muted and actually below earnings because we do expect a multiple contraction. So the fair multiple to pay for the market overall is probably not 21.5. It's probably closer to 18 times, 18.5 times. So it's a slow grind higher, a lot more about what's happening beneath the surface.
But longer term in a normalized environment, Gabriela, you're saying that we should be trading lower. That maybe this pullback that we're seeing in the markets is warranted. I mean, if that's what if that's what the markets are looking forward to, the normalized economy, and you're saying that we should be trading at 18, then the markets have it right here, whether or not it's a response to bond yields or not.
So I do think, I think the trajectory for the market over the next 6 months, 12 months, 18 months is higher. It's a slow grind higher. And what gets you higher is the revision upwards of earnings expectations. That we very much still expect to continue even in a normalized economy. It's just that your return won't keep up with earnings because you will have that multiple contraction. And we've already seen that the first half of the year. Expectations have moved higher 20%, but the market's only returned 15% because we had a multiple contraction of about 5 percentage points.
Right. The E gets bigger and the denominator.
Exactly, the E gets bigger.
So we're fighting about 125 being the 200-day moving average, violating that, possibly going to 1, and you just look past that. You say that's just noise because this bond market is distorted. There's no message coming from the bond market in your view.
Absolutely. We don't think there is a fundamental message here, and that is important in terms of portfolio positioning. We don't think we should be making adjustments at this moment in time. We do expect that re-steepening of the curve, which means we're still in the danger zone here for fixed income. We still do want to be underweight duration. We still want to focus more on extended sectors versus core bonds. And it also means we wouldn't be changing our risk-on positioning, especially reflected in equities. And especially, we still continue to like certain sectors, both within growth and within value. And financials is a big one within value that can still benefit up ahead from a re-steepening of the curve. The one thing we will say about equities is the most important factor we expect going forward, talking about normalization of the expansion, is quality. So much less about which style you pick, growth, value, but much more about focusing on quality as the most important factor.
Shepard Smith here. Thanks for watching CNBC on YouTube.